I think the biggest overall set of forces right now is the opposition between obviously the increasingly tight central bank policy, especially from the Fed, as they keep rates high, they reduce their balance sheet, um, being offset by the sheer amount of fiscal stimulus that is happening in the form of basically uncontrolled deficits. And what makes this type of period different than most other periods, except for going back to the 40s, is that normally, like let's say in the 70s when you raise interest rates and you have very low public debt levels, the downward force you put on money creation from banks is a lot bigger than the upward force you put on your own government finances through higher interest expense.
Hmm.
Um, and then as you get more and more debt on the public ledger, um, that interest rate setting mechanism gets less balanced because now when you raise interest rates, although it does slow down bank lending, and we're seeing that, it also completely explodes the fiscal deficit through higher interest expense, which is a type of stimulus. Um, and if you go all the way to like say Japan's case, it'd be even more extreme, right? So the more public debt you have, the less intuitive that interest rate channel gets as a policy tool. So we have these kind of two very competing forces right now.
Lyn Alden intricately examines the global economic landscape, spotlighting the intricate forces molding financial markets. Central to the discourse is the tension between central bank policies, especially the Fed, and the unprecedented surge in fiscal stimulus seen in soaring deficits. Alden adeptly dissects the contemporary challenges marked by towering public debt levels, acting as a cushion that diminishes the impact of conventional interest rate adjustments. This delicate balance necessitates strategic navigation to avert economic turbulence, a complexity further heightened by escalating geopolitical conflicts, casting ripples of uncertainty across global markets. Alden's exploration takes a captivating turn as she delves into the potential paradigm shift towards fiscal dominance, where the locus of economic control shifts from traditional monetary mechanisms to the realm of fiscal policy. This transformative shift fundamentally reshapes the dynamics of global finance, highlighting the intricate interplay between government decisions, market responses, and geopolitical events. As the conversation progresses, Alden hints at the looming specter of a second wave of inflation, a prospect poised to reshape investment landscapes and redirect the trajectories of economies. Let's dive into the rest of the video.
And then, of course, the other side of that, or in addition to that, it's the rising geopolitical conflicts around the world. So while we have these domestic fiscal issues, the U.S. is now strategically, financially involved in two war fronts to different degrees. And the way I would phrase it, more quantitative metrics is most of the fourth turnings, or actually all the fourth turnings, basically happening at major long-term debt cycle changes, as Ray Dalio would refer them to. So that's the more financial or quantitative background of what happens. And generally, these things tend to feed on each other. So, for example, um, sovereign debt crises can lead to more geopolitical instability, and geopolitical instability leads to sovereign debt crises. It's kind of like when you're vulnerable, that's when things are more likely to happen to you because there's more opportunity for them to happen. And so that's kind of the geopolitical stage while we have this fiscal and monetary backdrop. The risk mainly is that crowding out effect while you have that combination, because basically someone has to buy all these treasuries. It's currently not the Fed, it's not the domestic banking system, and with a strong dollar, it's not the foreign sector either. There's an unintuitive relationship there that if the dollar gets too strong too fast, the foreign sector actually generally stops buying treasuries. And if it gets disorderly, they could actually sell treasuries because basically they're in currency defense mode. They're not in reserve accumulation mode, they're in currency defense mode and servicing their debts mode. So what they need is dollars, and they can sell assets to get dollars. And so that risk is that all of this treasury issuance has to be absorbed by the domestic non-bank sector, which is households, hedge funds, asset managers, pensions, basically different pools of capital. And basically, it's a liquidity squeeze. It's pushing downward pressure on the private sector, which in some cases is good, some cases is bad. But the public sector is just completely not sensitive to interest rates. I mean, no congressmen are going to make decisions about things based on the Fed's current interest rate, like a business would. Um, and when we look at these big buckets of spending, there's the Social Security, Medicare, military. Those are and the interest expense. Those are the by far the biggest chunk of the budget. and they're all unpopular cut. And then now with the geopolitical issues, I mean, even defense is now it's more likely to go up than down.
Mhm.
And so and then basically there's no appetite for major tax increases, especially when you have a polarized Congress. So the combination of nothing meaningful is easy to cut, and there's no meaningful way to kind of increase revenue. And so I think these deficits are set to continue. And so we are in that, as you said, that burnout phase, at least while um, there's still some pools of liquidity. So we're burning down reverse repos. That's coming back into the market. That's like the kind of the final source of liquidity out there.
Mhm.
And so basically we're in this kind of stall period until kind of existing liquidity is used up. So I would expect the fiscal to win out, meaning that I think the central bank has to shape itself around fiscal rather than fiscal choices shaping themselves around the central bank. At the end of the day, those in charge of the fiscal lever can override the monetary lever. And what form that takes in, we'll see. I mean, this is obviously a complex, ever-changing situation, but a good model for this is the 2019 repo spike, which in many, basically the Federal Reserve was doing quantitative tightening. There were an increasing amount of T-bills coming to market. There was no longer any reverse repo facility, and hedge funds were big buyers of treasuries, and they were using the repo market to finance themselves. And eventually, basically all that liquidity got tapped out, the repo rate spiked, and then the Fed had to come in. First, they provided repo, then they had to stop decreasing their balance sheet. Then they started, just buying T-bills outright. So even though it was a repo problem, they had to go and actually fix the T-bill oversupply problem. Now that was politically, it was complex because their messaging was this is not QE, we're just buying T-bills, um, and of course there was officially not high inflation, so they had some covered. It wasn't like a necessarily a big issue. It did have market impacts. I think you could see a similar thing, maybe 2024. If they kick it a little further, maybe 2025. I would guess 2024, but we'll see. And then there might be a thing where the Fed has to stop reducing its balance sheet to basically you have a treasury market go liquid or something, kind of like the gilt market last year. And then basically you're in fiscal dominance where the central bank has kind of limited control of its own balance sheet size because there's just so much fiscal on the market. Yeah, so when we think of the 70s, basically there was monetary dominance, meaning you had smaller public deficits, smaller debt levels, and so those monetary levers were a lot stronger. When you get the fiscal dominance, there's a couple ways of looking at it, but basically that fiscal is what's overriding things. Monetary policy gets less flexible because they're being overridden by basically the large fiscal forces that are at play. Very large public debts, very large public deficits, and so fiscal changes, so like tax increases, stimulus, that kind of thing, end up being far more important for the economy and for financial markets than central bank decisions. I think that would be the risk for a second wave of inflation. So we've had, inflation historically often comes in waves, where you have inflation, then you get under control, but the underlying force is still there. And as soon as you kind of, stop suppressing it, it comes right back. It's like holding a volleyball underwater. You let go, it comes back up for a second bounce. Um, and there's really kind of I think two main ways that can happen. One is some sort of energy supply disruption, which considering how tight the market is, any given week or month is always a possibility, especially given some recent events. And the other one would be basically if the Fed is no longer able to tighten their balance sheet despite above target inflation, um, then basically the market can lose faith in the Fed's credibility. They can have a very kind of different view of how things are going to turn out. And then we start going to, I think, the more Japan route, where even when you're above target inflation, you're still doing QE, um, for lack of a better thing to do. And then I think especially when you're in a an environment where you're also running a trade deficit, and you're in an environment that's more of a tight commodity market, which was say not the 2010s decade. So Japan, a lot of their central bank balance sheet expansion happened from say late 2012 to the present. Most of that was in a commodity bear market. Whereas if this type of thing happens in a commodity bull market or a tight commodity market, especially a tight energy market, that combination can be quite inflationary and give you the second round of potential inflation.
As we wrap up this insightful discussion, let's recap the crucial takeaways. We're witnessing a unique economic scenario where the tightening policies of central banks clash with extensive fiscal stimulus, creating a complex financial landscape. This period, reminiscent of post-World War II, is marked by the interplay of interest rates, soaring public debts, and escalating global conflicts. Geopolitical tensions are shaping economic policies, adding further complexity to the financial markets. Moreover, there's a looming risk of a second wave of inflation, driven by potential energy supply disruptions and a loss of faith in the Fed's credibility. If you found this analysis valuable, show your support by liking, sharing, and subscribing. Stay tuned for more in-depth discussions.